Hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. There's a weekly webinar we do, looking at some of the things happening in the market and also showing some of the ways we can understand things happening in the stock market and trading using the power of TradeStation's platform. So I'm going to start with some quick disclosures. I'm also going to share some things in the chat, some different key things that you might want to use for reference. Now, remember, if you go to tradestation.com, and from there, once you're in tradestation.com, if you go to the research and then insights button at the top, it will take you to our blog, the Market Insights blog. And that blog will have an article about the Punch Bowl. That is today's webinar. Will the Punch Bowl return next year? That is a lot of key points we're going to be working through today. We also have a download. If you have the TradeStation platform running, you'll be able to import some of our special tools and indicators, and from that you can then launch various workspaces and things. So really quickly to start, if you're in tradestation.com, you go to Insights. Sorry, it's not called Research, just Insights right here, and it will bring you through to this article. Will the Punch Bowl return next year? Just click on that, and these are some of the points we're going to be working through today. All right. So very quickly to start, I think it's important to say that a lot of this really important rotation is now happening. Let me just start by looking at the S&P. Last week, we looked at this downward trend line. We said whenever you see a triangle, it's a powerful thing and don't ignore it. And the thing is that it remained in effect for another day or two, and then a continuation happened to the upside. And so I think this is important. I mean, it was a valid pattern, but the fact is that there simply was not any selling pressure. And now we're seeing a lot of obviously follow through or different things, with the Fed being more dovish than I think anyone expected. But let's really show some of the ways to understand this using the TradeStation platform, which we always like to start over here on our MT main. It's called November 2023 workspace. Now, remember, if you actually, so if you go to this blog post really quickly, you see downloads available here. If you open up this downloads, it will bring you to a zip file. And if you go into the zip file, you'll basically see a folder here called public materials. Go in one more, and you'll see a whole bunch of items here. These are workspaces with the blue icon. And then you have these other things that are called easy language documents. So if you import those to your TradeStation platform, they have custom indicators. Those custom indicators are then used by the different workspaces. So if you import those custom indicators, you can then use these workspaces. Like these different workspaces that I use that you see on my tabs are all included here as these TSW files. That's the way it works. So right now we're going to go to the MT main workspace. And what I really want to point out right here is the price performance in the last 10 days and the last 21 days. This, I always like to look at the market with your time frames and seeing where is the strength going, where is it leaving. And what we see here, what's really interesting to me that jumps out, is the relative performance now of the value versus growth, IWD versus IWF ETF. Those two are showing dramatic change now. As I think most people know, mega cap growth stocks have been the leaders this year, but things have really changed in the last month to month and a half in various ways. And we've seen really what is now a significant sort of rotation in the market. And I want to mention also that if you look at our Market Insights blog, we do a lot of different blog posts. Back on the 4th of December, we noted this article about the mega caps lag as banks in particular were coming back to life. So I think it's important to realize here that this trend now is not just it's not just a few blips on the radar screen. This is now a full-blown sort of pattern that we're seeing. There's a lot of confirmation now that we seem to be entering this period of money moving away from the mega cap growth stocks. So we can see that in a lot of ways. To me, one of the main ways, very simply right off the bat, is just today, if we look, we can see that the Qs are down 0.5% and the small caps are up 2%. We can see that the value is up 1% and the growth is down 0.7%. on a 10 day or 2 week trailing performance. We can see a 200 basis point differential. We can see in the last we can see more than that in the last month. It was really interesting if you look on a year-to-date basis, which is a great thing about having this radar screen set up with the award-winning TradeStation platform, is that we can actually compare these price performances on a year-to-date basis. We see the growth is way ahead of value. So what we're seeing something new, and it's been happening in the last month to month and a half, and that's important because in the market, those kind of newer trends can be the ones that really give the performance. And I think it's important also to realize that these areas that have been here, like we're talking about banks, they took a beating earlier this year when Silicon Valley went down, and that money is now coming back to them. You have things like home builders, which are interesting as well, but actually, it's a different story. I'm going to get to that. But you see just a lot of things. I mean, in particular, the banks, but a lot of things like traditional retail. We're going to dig through where some of these areas are, because to be honest, this is changing so quickly, and there's so many things happening at this time that the only way we can understand it is to fire up TradeStation and really see all the tools it gives us. So right now, to make sure I even can do that, let me make sure I'm bringing in the S&P 500 in my grids that I'm going to do that here. So we have our price grid. Price grid is a special thing I created that allows us to track relative strength performance across the entire S&P 500 over multiple time frames. Right now it's blank. I often keep but I'm going to bring in add symbol this S&P 500. I do this. I keep it blank for various reasons. One of the main reasons is because the S&P changes, and this way I just load it. And then I'm out. I don't get stuck with old index members in there. Another reason is that there's no reason to be a data hog and be sucking through data on 500 symbols when you don't have to. So go to data, add symbol list. This is now my MA tools workspace, and I'm also going to go to my fundamentals workspace. So now I'm going to be sucking through data on the entire S&P 500. I'll let that populate in the background as we go back over here. But I think it's really important to realize that this is something people have been talking about for a while. There's been a lot of hand wringing about over concentration in the Magnificent Seven and all that. And, it's all true. And like Jesse Livermore said something like, he said something along the lines of don't trust your opinion until the market confirms it, something like that. So for a long time, there's been people complaining about, lack of diversification or lack of breadth in the market. And it's a problem. And now suddenly what we're getting confirmation that this situation is now reversing. And now that we have the confirmation, it's been an opinion, like Jesse Livermore would say, now the market's confirming it. And that means that we need to react quickly to this and start looking for how things are behaving differently. We've been talking about what's happening in financials and banks. We were talking about those breakouts of the falling trend lines several weeks ago. And now we're going to keep looking for more things that are happening as we move through this webinar. But first, a little bit more just to show how we can diagnose these trends and understand them is, first of all, I'm going to add a special thing. I'm going to add just another little quick workspace to show you how easy it can be to actually compare some of these things with TradeStation. I'm right now looking at the NASDAQ futures generic symbol NQ. I like this because I just want to show that I'm using the futures generic symbol, and it allows me to compare it. I'm going to compare it on a weekly basis. Now look at this. I have just a straight up chart of NASDAQ futures. What I'm going to now do is I'm going to go to studies, add study. I'm going to put in relative strength. Relative strength is something that just compares one symbol against another. By default, it compares to the S&P 500. What's interesting about this is you can see the NASDAQ outperformed. It was above here. Let's make this a little bit easier to read, though. What I'm going to do now is I'm going to change. I'm going to change, first of all, the style. I'm going to change it to being a histogram, make it a little bit thicker. But I'm going to change SPY to RTY, the Russell. So we're looking now at the Russell futures, the NASDAQ futures against the Russell futures. And let's just look at the incredible outperformance that the NASDAQ has really had against the Russell for a long time here. And so I think it's important to realize that if this trend starts to happen and we get that return to small caps and we get that return to value, there's a lot of space. We have had a large cap outperformance for years, which means that a lot of these sort of non-large cap growth stocks are underowned. There's millions of investors out there who haven't looked at the banks probably in a decade. They haven't looked at industrial stocks in a long time. There's a lot of these value stocks, retailers in particular, what's happening in Gap, what's happening in Abercrombie, which we mentioned a while back, what's been happening with Macy's. People have left these stocks for dead. So there's a lot of people now who can return to these names who have ignored them. And this is kind of what the process works out. So if this continues, there will be a process, or there could be a process in the coming weeks and months and quarters of people rediscovering areas where they didn't look before. And it's one of those things where if you start to look, then eventually some of that will become potentially buying. So I think the thing is that as attention focuses, as this relative strength, as we see highlighted here on the radar screen, as people are looking at these sort of relative strength in the market, strength will often beget strength. And this is going to be the thing that draws the interest and then gets potentially new dollars moving in new directions. So it's important for us to always start with this sort of relative strength analysis using radar screen to understand where the money is moving in the market. So it's interesting that I think right now, people sometimes say there's an everything rally. I would like to coin the idea of there being an everything else rally. And I would say that the risk we now face is that everything except the Magnificent Seven could benefit, and they become sources of funds for the entire market as people rotate into banks, industrials, and home builders, and retail and real estate investment trusts and utilities that have all been hammered. As they look to buy those, where are they getting their money from? They're going to be saying, hey, let's sell a little Apple, sell a little Amazon, sell a little Microsoft. And it's not because there's anything wrong with those stocks. It's just that it all comes down to relative value and relative strength in the market. So this process, I think, is important. We don't want to ignore this. I think is important to kind of think about what's happening. There's two more points I want to make. First of all, Adobe had a pretty not so terrific earnings report. And I think it kind of shows that you can hear ADBE. Wait, that's not ADBE. It just kind of shows that this has been kind of a classic growth name, and it's done very well, for months here. But I think it's also as important to realize now that it's a company trades at a relatively high multiple, and it shows that there's other shows in town aside from AI, which is a part of this story, aside from software, aside from secular growth stocks. There's also these cyclical names. So I think the Adobe thing wakes people up to the fact that, wait a second, home builders are up 5% today and the NASDAQ is down. Adobe is down and the home builders are up. This is kind of what we're talking about. I think the other thing that's important to realize that I'm aware of, and I'm kind of just wary of as we move into the next, month and the early January and stuff, is that there's a lot of people who are probably sitting on significant gains in your Nvidias and your Apples. They're sitting on big gains in these tech stocks. And when the new year begins, I think there's risk of tax selling. People are going to be like, hey, I don't want to pay my capital gains tax in April of 2024. I'd rather pay it in April of 2025. And so there's a chance of profit taking and people selling those big winners in January to push out the tax payments by another 12 months. And so as I look at that potential process in place, I think it does create risk of this diversification trade, of this rotation continuing and potentially amplifying in the coming weeks. So I think that this is a reason we want to continue to focus on this. All right, so let's take a look at my blog post for today here. These are some of the key points. The Dow closed at a record high yesterday. I'm just looking at some of these different points. These are all they just can kind of continue today with continued strength, but the advanced decline line hit record highs. which means we have strong breadth, more participation by more stocks, more companies making 52-week highs. I'm going to show you how to do all this in the TradeStation platform. But all right, let's just quickly hit on what the Fed said here. I mean, to me, it's pretty interesting because this is everything here, this dot plot. They basically went, I think people expected it to be a little bit, when you really look at, this was, looking essentially for 25 basis points of cuts next year. And instead they went to essentially 75. But, there's still a decent amount of people kind of down here at 100 basis points of cuts. So, I mean, it really shows is that the Fed's basically they were more dovish than anyone expected. I mean, I expected they were going to come out and say, well, we're still not sure about inflation and, we blah, blah, blah. And instead they basically came out and said, we're not worried about inflation or we're going to be cutting rates next year. I mean, it was dovish. It was unexpected. And I think we all know that now. So it's important. I mean, these are some of the key things. The fact is that economic activity has slowed substantially. But to me, right off the beginning, they said inflation has eased over the past year. I mean, that was it. At that moment when we saw that line, the market just went into buying. And I think that's a key thing for them to recognize that inflation is eased and economic activity has slowed substantially. What's also interesting is they lowered their inflation forecast for next year. They added a little bit of language of saying any additional policy firming, whatever. But I think it's important to realize here that in my judgment of things, and I've been talking about this since early November, right? There have been three major events that show sentiment has changed from despair bear market to a new bull market. And the first one, as we mentioned at the time, I think it was the beginning of November or the end of October, we had this massive revision to productivity and unit labor costs. And I think this highlights one of the key things, which is that the inflation data, I believe, and I'm not the only one to say this, is it's basically overstating inflation. Now, a lot of people say, well, prices haven't come down and blah, blah, blah. But it doesn't matter what a price is. What matters is what is the price versus 12 months ago. That's inflation. Whatever you think about it, that's the number. So it's a rate of change over the trailing 12 months. That's the number that the Fed looks at. And I think when you look at it, the inflation numbers earlier, was it yesterday? Yeah, yesterday, the inflation numbers showed used car prices not falling. Last week, we were showing all this data about used car prices falling. And I just have to say, I would not be surprised if that trickles through in another month or two, or if there's some kind of revision. Secondly, the rent numbers didn't go down much. But look at this article here. We see here today, it was on CNBC and it was also on CNN Money. I think it was in a lot of places. Manhattan rents dropped for the first time in over 2 years. So the thing is this process of rents dropping is happening. Now, the other thing I just got to say, what happens when rates come down and people who are locked in apartments start looking and buying houses? The downward pressure on rents is probably going to increase. We have more rentals coming online at the very same time that there's going to be a mass exodus out of apartments into new homes or into homes of some kind, either new or existing. So the key thing is that I think the Fed sees this, and I also think that they might not say it, but there's a lot of consensus among economists that the data is just not quite right. And if anything, at this point, it's more likely to be overstating the problem, which means that as time goes on, that the conditions will actually break in a positive or a bullish direction or a dovish direction. I don't want to say positive because that might mean inflation going up, but it essentially will break in a direction of lower inflation and better news for the market. And I think it's important to realize there's times when everything goes right and everything goes wrong. So back in 2007, people thought the market would never crash. Things were wonderful. Optimism was very high, and they were completely wrong. This time is the exact opposite. Now we have low debt levels. We have inflation coming down. We have all these signs of all the problems having passed, and the emotions remain very negative, or at least they did until a week or two ago. So let's actually look again at these points in my blog. First of all, the revision to unit labor costs, that showed that we had something of a change that happened. The next thing was a historic change in the American Association of Individual Investor Investment. The sentiment had the biggest change in you know, over a decade. It depends how you look at it. Go ahead and click on the link, read the article. We highlighted it at the time. The other thing is last Friday, it was the consumer sentiment number we got. When was this? I'm sorry. Was this on this was last week. Yeah. This was huge. Basically, this consumer sentiment number, I remember now, this came out. I published an article on Monday. The number was on Friday of last week. I mean, this was huge when you look at the comments here. Sentiment across income, education. It's all about inflation. So what's been interesting, and I think a dominating feature of the data, especially, I would say I think it really started with all the political back and forth about Trump back in 1819, when you would see consistently that people seem to be saying, I'm negative on the economy because I don't like Trump, or I do like Trump, or something like that. And we have seen the sentiment data. And then COVID came along and it made the data even more politicized and less based in reality. So the thing is that I think what's interesting now is that we're actually starting to see the data move away from people's sense of either politics or macroeconomic, and actually suddenly realizing, wait a second, prices are getting better, wages are good, and things like that. And we're actually starting to see now that Main Street is catching up with some of the reality in the data, which, like I said, is far better than most people really believe. If you talk to most people who are not in the stock market, if you talk to them 2 months ago, they would have basically said that we're headed for a financial crisis. The world's going to end. I mean, so the amount of despair was huge. At the same time, what does that mean? It means all those people's dollars sitting in money market accounts can now be moving into equities, and that is what we're seeing. So I think this is a really major change. It's been a three-part, at least three different parts. I would say that we saw it in these various numbers, but then the thing is that the Fed is kind of the fourth domino to fall. So now we kind of see that this entire artifice or belief of this bad scenario has basically been deconstructed, and now there's people scrambling to catch up. All right, so it's kind of interesting now is this consumer sentiment. I really encourage you guys, Google University of Michigan consumer sentiment. I read all these data reports. I mean, I know it's not the most exciting thing, but this was a big one. This was a pretty significant change. You check it out. You'll find it interesting. The CPI was, in line with forecast. PPI a little softer than expected, but again, doesn't really matter that much because we're no longer looking at these huge changes. And the other thing, like I said, if you have the working assumption that the data is overstating inflation and prices, then 0.1% more than expected. It's not, this ship has sailed. At this point in time, the tide has turned, and the market, that's where the market is. So one of the things that's interesting to me is there's a guy named Dan Premack. I remember he used to work at some private, when I used to work in the credit market, the guy Dan Premack used to work at some kind of private equity newsletter. He's always been a respected guy on LBOs and private equity. Now he works at Axios. And what's interesting is he basically is talking about M&A coming back. Now, remember, M&A has been a non-issue for a long time. I remember back in 06, 07, 08, or even throughout 2012 or 13, we had takeover chatter and people buying calls on stuff before it was, these M&A rumors and all that stuff. M&A has not been a driver of the market for a long time, and it's starting to come back, like we saw with things like Macy's and stuff like that. So when you have so many small companies and all that sort of stuff, that's why, the small caps, the mid cap, the value, that is more of an M&A thing. No one's going to buy Apple. That's the problem with Apple or Microsoft. But when you look at some of the smaller names, somebody might buy them. And that actually, as the market moves in that direction, I'm telling you folks, if you've only been in the market or looking at it for less than 5 years, you don't remember what it was like when there was takeover chatter over, industrial stocks or over retail stocks. But it can be a powerful force. And we haven't seen this in over a decade now. And this is what we're actually seeing reassert itself in the last few weeks. So this is a guy I've read sometimes. He's kind of interesting, Charlie Bilello. He just has a lot of interesting economic insights. He's on Twitter. He's noticed that wages are now outpacing inflation, for the last 6 or 7 months after lagging for 25 months. And so he might have actually said 35 months. But anyway, the thing is that, again, you know, people's opinions very often lag reality. And so the thing is a lot of people who've decided the world is bad, and, you know, then it's not so bad, but it takes them a while to admit that things actually are getting better. And so the thing is that we're now in that spot where we're just on that cusp of things changing, and that's where we are right now. And I think it's important to realize this moment in time we are in right now is that, there's a lot of to suggest it is that turn. Now, remember, we'd also talked about this huge amount of money that's in money market funds. So all these things kind of fit in the same direction, that we are actually at a major turning point right now. Again, what happens as we get into a new year and people start to see the market go up and they see rates come down, inflation not be so bad, there's going to potentially be a cascade of things getting better and of sentiment getting better, of more people wanting to own stocks. So that increases the potential of the VIX remaining low, money continuing to trickle into the market, and pullbacks being very limited. Ed Yardeni, guy I respect, he's been around for a long time. He has price targets of the S&P going to 5,400 next year and 6,000 in 2025. It's interesting, if you look at FactSet, they do an average. They look at all these analyst reports. They take the S&P 500 and they crunch numbers to say, if we take all the price targets for all the companies, they basically get a number of 5,068 on the S&P at the end of next year. HSBC said 5,000 on the S&P next year. That was just yesterday. So anyway, these numbers are trickling through. Again, very often when people raise their price targets and stuff, it's the end of the story. But at the same time, let's just go back to this longer term chart here of the S&P. We'll just do a real quick weekly chart. I'm going to just add another one really quick. But I think it's important for us to keep our eye on this pattern of the S&P on the weekly. And this is just, to me, a really, really important thing that we don't want to forget about, was that we've seen a pattern historically of these periods of time. Well, this is 2008, the crash. But then if you look, as this bull run has begun, you can see it has these periods of 18 to 20 months of consolidation with continuation. So this was back with Obama getting reelected and the whole debt ceiling, and then he passed Obamacare, and then we broke out of that, and healthcare stocks ran really hard out of that news. And then in 2015 or so, we stalled. We had a period of consolidation there. Then after Trump got elected, we ran again. Then he did the trade war and the market stalled. All through this period, there was a trade war. Then the trade war with China ended in October of 19, and we started a new leg up. Now, COVID knocked it down, but in my view, if you look at market cycles, there was a lot of reason to think that if COVID hadn't happened, the market would have more or less done the same thing it did. Maybe not gone as much to the upside. There wouldn't have been as much money printing. But I mean, this move would have just been, so let's just ignore COVID and just say, basically, we see these cycles of basically sideways movement and continuation. And what do we have now? Again, we have another period of time. It doesn't look that different. It's just sideways movement with the potential, if this pattern continues to reassert itself, we have a period of time here of about 18 to kind of 20 months, something in that time frame of consolidation. And so the thing is if we start to break out of this, this is what the historical cycle seemed to point toward. So I think it's important to realize that. Now, look at some interesting things on Twitter that kind of grab my attention here. I'm going to just close these as I go. This is one guy. What's his name? All right. Yeah, I used to work with this guy a while back when I was at CNBC. I put him on TV sometimes, Ryan Dietrich, but he made this point that when the Dow starts making new highs, you tend to get follow through. And we've had charts like this on TradeStation as well that I've shown you guys. But I think it's important to realize that as we start to make these new highs, let's look at the Dow, for example, as it starts to make new highs, usually there's that kind of continuation. And I would add that, very often, if you have this kind of low volatility and you have some nice basing along the way and some reasons for it to make sense. Sometimes you'll get these kind of, like this high here in '07, right before the crash, but the thing to remember about this is these were the highs that mattered, that showed continuation was coming. This is '06, new highs, and then you get continuation. This is like your last dying gasp that came shortly after. But this is different here because now we've gone a long period without any new highs. And so this, in many ways, if you look at history, could be much more like, these new highs when it starts to break out, when it's been dead and it starts to break out, then you get the continuation. So I think it's important to realize that. And we've talked about the fact that NASDAQ was starting to close at new highs, new weekly closing highs, things like that. So all of these have kind of confirmed the positive underlying conditions. So I thought that was an interesting one from Ryan Dietrich. Another one was Carl Quintanilla. He posted this thing was kind of interesting about small caps. And he just kind of showed how, when stocks are off, when they're down like 70, 80% long term or something, they can really snap back a lot. And so I think, you can go through these periods of time when you're going to get people just going and value hunting, beaten down stocks and say, who cares about Apple now? I'm going to buy beaten down stocks. And, a stock went from $10 to $3 and now it can go to $5. And that's a big percentage move. And this becomes a new kind of trading, and it seems to be happening right now. So he tweeted about it. It's kind of interesting. I also noticed this shortly before. I didn't actually know anything about this. I just literally saw it like 15 minutes before the webinar. But Intel now has a new AI chip. Intel has been pretty strong this year. It's something of a comeback play. A lot of weird stuff with Intel that honestly I don't fully understand, exactly what's going on, where they're doing a bunch of different business transitions and things, but the price action has been there. It's a member of the Dow. It's interesting to see names like Boeing come back and Intel come back. And there's some other Dow members. I can't remember them right now, but to see this sort of strength, these names that have been neglected for so long, so I think Intel now is going to be a potential name to watch going into the new year. Jerome Powell said yesterday, when do we want to dial back our restrictive stance? And I think it's important to realize this now, that as inflation moderates, the Fed is tightening. What do I mean? What I mean is that if they stay at 5.25, then basically as inflation inches down on a relative basis, their policy is higher in real terms, which means that it's actually more restrictive simply by not changing. So I think that that's actually a big thing here, is that the Fed now, in order to stay normal, is going to have to start cutting. Now, it doesn't mean right away. People are looking for March. But like I said here in my blog post, where was it? What did they see now a 75% chance, CME, this is yesterday, the rate cut in March, the odds of a rate cut in March have doubled in the last week, from 38% to 75% based on the CME FedWatch tool. So again, as that inflation moderates, without a rate cut, you're actually raising rates. All right, so these are some of the different articles I wanted to mention. We did this one on December 4th. We did this other one here on this week, and we talked about home builders. And we have been kind of mentioning this as an area that benefited from both an improving macroeconomic condition of lower interest rates, but also the fundamentals and the fact that there's simply a shortage of homes. So I'd actually like to posit an idea that might sound a little bit strange, but I think it's really what's happening. And I would say that right now, we are not recovering from inflation in 2021 and 2022. We are recovering from the housing crisis of 2008. So the thing is, the American economy has been in a malaise since the financial crisis. It was just getting back to normal before COVID. Then COVID caused all kinds of crash and recovery. We had fiscal stimulus that overstated the recovery, pumped a lot of money into capital investment and stuff like that. And let's see how much that continues. But what's really happening now, with retail sales beating estimates for, I think, 5 straight months now, what we're really seeing is we are going back to the way things were before the housing crash, where now we have a shortage of homes. People need to buy homes. People have paid down debt. We have a huge amount of home equity in the houses that are out there right now. People are under leveraged and they don't have enough houses. So there's now a potential here for a multi-quarter, long-term rebuilding of our housing, re-leveraging the consumer, and that entire movement of consumer spending. The other thing we have is we had that retail apocalypse in 2015. So basically now the entire retail industry has been through the ringer of getting crushed by Amazon. But it's interesting. Take a look at Etsy. Etsy came out yesterday, I think it was yesterday, with a pretty horrific profit warning. And they cut their head count and stuff, but it was a bad outlook. So it's interesting to look at the fact that a name like Etsy, I think at the same time that the retailers are doing well, the traditional retailers are doing well, what it tells us is, again, it tells us that we are seeing, at this point, a shift back to that older America. I don't want to say before e-commerce, nothing like that. But the older economy, these things like housing, traditional retail, these things, this part of the economy has been dormant for 15 years. And for it to come back now creates all kinds of new opportunities. And there's things that people have literally not thought about for a long time that are coming back. So I really think it's important to realize that this is not just about recovering from inflation. There were things happening in the economy as we were recovering from COVID. And those are really bigger forces than what the Fed is doing now. Well, maybe not bigger, but those are real forces that are happening in the economy. The shortage of homes, the total lack of investment in new homes and things like that we had for a long time. All right. So also, over on TradingView, all right, let me just show you really quickly. If you look, we do these ideas on TradingView as well. And all right, you can go up here and there's a link to our TradingView ideas. We did a thing today on the dollar. And I want to just kind of point out that this is the dollar index, kind of long-term chart of the dollar index. But, I think it's interesting to look here that there's a potential for, some significant downside here. There's a monthly chart of the dollar index. If you look on a daily chart as well, I mean, kind of any way you look at it, I think people can see the potential for kind of continued weakness in the dollar. It's not to say it's a trade they want to chase right now. But again, what does that do? That creates the the potential for all sorts of things that happen in markets with both things like metals, global equities, and general risk appetite when the dollar weakens. So I think there's a pretty significant trend we want to keep an eye on in terms of what's happening with currencies. A lot of the other ideas we have here on TradingView, we did this thing yesterday on Netflix. It was pretty interesting. This has remained an interesting name for me. I've not yet looked at it today. And I mean, my concern about Netflix is that now it's a mega cap. It's not a Magnificent Seven, but it's one of the major NASDAQ growth stocks. And the other problem now with a name like this is it's non-cyclical. So if people say, hey, I want a stock that's going to help me profit from the economy recovering and the Fed cutting rates, Netflix doesn't do that for you. And that, I think, is a problem with a name like this right now. But we did this idea on it yesterday, very interesting chart pattern. So I want to just kind of point at some of these. I'm not sure at this point, these ideas. The Fed was so dovish that, we got to adjust to some of these new scenarios. So just looking at the other things on here. Let's really quickly go back over here and let's get to the stuff I wanted to talk about. So again, this is the NASDAQ against the Russell. And the thing is if we start to enter a period now of the Russell outperforming, that's going to open up kind of new potential. And let's just look on a daily basis now. And you can see that the NASDAQ has been really lagging the Russell in a pretty dramatic way here. So this, again, I think is the kind of trend that's going to be interesting. And it's not just the Russell. It's going to be stuff like the mid caps. And a lot of S&P 500 stocks are really mid caps. They're not officially that. So, all right. So now we have some tools here. Let me see if you have any questions. What studies you put on your chart? I have all kinds of studies on here. And some of them, in fact, I'll very quickly show you this. If we go to this one that we call MT Breadth, this is one you guys all have access to. if you have the workspace. The two things in particular stand out here are this is the advanced decline line that we showed in the other one, hitting record highs. And the other one is the number of companies hitting 52-week highs. Now, it's interesting if you look at this historically, because I remember there was a moment back in 2020, in 2021, when we had a whole bunch of stocks hitting new highs right here. And, the market just remained in a glide path higher after that. So when you start to really see significant numbers of new highs, that is, a healthy sign. And so I think it's important now to see that we have the advanced decline line, 93 new highs on the S&P 500 is 93. And then if we look over here, that's really the most, this is the most in a long time. I got to just look back, probably back here somewhere. So anyway, this is giving us that kind of, clue that we wanted to see. All right. The other thing I will just add is that gold is not really doing a huge amount to the upside. It's not really breaking out. Gold miners are not really breaking out. And I think that's a good thing. That is consistent with the bull market and equities. There could be an opportunity along here, and we do see, I've been expecting kind of some upside in silver, kind of looking for it, and it just turns into these kind of flash in the pan sort of thing. But that's over the longer run, the sign of a secular bull market in stocks. We don't want to see gold miners and gold doing well. So that's the SM. All right. So now let's get into the stuff we wanted to talk about. So let's go back to our MT main. Let's go to price grid. Actually, before we do that, let me just quickly show you. These are standardized returns, some of the ETFs we talk about. It's always good to just take a look at those. I'm not sure how many of them we're even talking about today, but we did show some of those on the other screen. So I want to give you guys a second to actually see these standardized returns. We use them on the key ETFs. And the thing I like about using kind of ETFs as a little kind of index for prices is that, it's all normal equity pricing data. Some people might have or may not have subscription to different indexes and things like that. Some people might not have futures data, so you might not be able to look at RTY, for example. All right, so we can go to our price grid, and we can see distance from 52-week high. All right. And this will show you stocks. It shows the high price of today against the 52-week high based on yesterday's close. So if a stock is making a new 52-week high today, it will have a positive value. Anything under 0 means that, it's below. So look at the number. There's a large number of stocks. If I actually look at this, these numbers probably update separately. Well, it's a rounding issue. If I go here and I edit this, you can see if I change the style and I change it to, these decimal points, we can actually see that there's about 95 companies, at least on this list, that are showing as new highs in the S&P 500. So this right off the bat will tell you, using this tool, look at Blackstone. Wow. We had talked about these LBO stocks a while back, the private equity firms. And I remember us saying on this webinar, we said, when you look at this strength in the private equity names, it's hard to really, it's not confirming downside in the S&P. And we were saying that when it was like down here or something. So it's kind of interesting. But Blackstone, look at the other names that are leading. Lennar, Home Builder, URI. Now this stock used to be a really active trading stock. United Rentals. Again, it's not Apple or Nvidia, but this thing can move, and it can be an interesting trading vehicle. So it's United Rentals is an industrial company. They do a lot of business with construction firms. If you want to if you go by a construction site, you're often going to see like the forklifts and all those things. I don't know what you call those machines they use to like hoist up drywall up to a house or something, or to move roofing. All those things tend to be there. I always see United Rental logos on them when I walk by, construction sites and stuff. So these guys are not officially a housing stock, but they are connected to the industry and they have business there. So just look at this, Lennar is a home builder, DR Horton, Pulte Home, Masco, they make cabinets. So this is these are the home builders here that are all just housing is just the theme that's like, wow, I can't believe it. Home Depot's hitting a 52-week high. I can't believe, I had no idea. This thing is, wow. I had not looked at this stock in a while. That's pretty incredible. I did not know Home Depot was hitting a 52-week high today. But see, this is the sort of stuff that you can find when you look at Radar Screen a lot. And, you know, I think that the amount of information you can find using Radar Screen with analysis like this. So the thing is, names like this, as they start to move higher, they often continue. Now, for an example of that, we talked about, I mean, this is no longer maybe very interesting, but Garmin. We talked about how Garmin, we were talking about it back here, it hit a 52-week high and it sat and it continued. So the thing is names like this, we talked about GoDaddy. Now, these names are probably run for now, but we talked about it down here. We said, wow, it broke out on high volume to a new record high, and it just continued. Now it's probably, you know, probably getting, you know, who knows? I mean, that was a month and a half ago. So not to say it's going to continue from here, but some of these names, I mean, like a Home Depot or something, I mean, it's going to be interesting to see, you know, the pattern on these. But I think that now we want to be looking. So right off the bat, this tool, distance from 52-week high, that's the first tool I wanted to show you guys. It's in the zip file. If you import all of the ELDs, it will then be available to you when you use TradeStation. It's in this workspace that we've shared with you, but at the same time, you can use it yourself, but you just add studies. The next indicator I want to look at is days since 52-week high. So this will show us stocks. And one of my favorite scans, and it just tends to work, and I'm going to show you this in a second, is let's look for stocks that have made a new 52-week high in the last, 10 days. And this might actually be kind of, given the dramatic move in the last 48 hours, this might not actually work at this exact moment. I'm going to go here and I'm going to add a blank. I'm going to add a label row, and now I can sort. So this will show me companies that made 52-week highs in the last 2 weeks. And then all I do is I click on 5D to show them in terms of who's done the worst in the last 5 days. So it made a high in the last 2 weeks, but it's pulled back in the last 5 days. And now I'm going to see a bunch of stocks that are, kind of pulling back. A lot of these now are, like I said, this kind of analysis might not work right now. But I think the thing that's going to be more interesting are going to be those names that are near highs, that are kind of hitting new highs. Some of these now that are pulling back, because the problem with Progressive is it's a safety play, and that's not what people are necessarily going to want. But some of them, you might have, today the market's following through. I would say that in next week, this approach, this scan will work. With today, with things up like this, most of these stocks that are hitting new highs, they're hitting new highs again today. But then in 3, 4, 5 days from now, they could be down 2 to 3%, and you would find them using this method. So you would basically isolate those stocks that have made new highs in the last 2 weeks by adding a label row like I did right here. And then once you do that, everything I sort is now inside of this group that I created. It's like I created a little mini group, and then I can kind of, check them out within that group. So that's another approach. All right, now we have, all right, let me show you how to do this with Scanner. So I'm now going to go to a new workspace. I'm going to just add my flashlight, my scanner. Now, remember, for you guys, the apps might be in a different order because I've moved these around. It's kind of cool. You can actually move stuff around. See, I don't like basket order. We'll put it over there. Stuff like that. You can move stuff around. So I don't know where your flashlight is. I'll move it over here because I like that one. These are the three I use most. I also use Radar. I use Option Station Pro, so I'll move that over. All right. Anyway, so now I have my scanner. I'm going to go very quickly to make it bigger. I'm going to just go to Window. I'm going to go to Font, and I'm going to go to Headings. I'm going to just make it a big font so you can see better. Okay. Now, I'm going to go to Create Scan, and I just give it today's date so I can keep it straight, 12/14. Now, we go to All Stocks. Now, an easier way to do this, and this is not available on Radar Screen, but it is available in Scanner, is you can, I have set up as a default to show market cap of $1 billion and price average volume of 500,000 shares. But then you can adjust that. I have it set as a default. If you set these, you can then save them as a default and it will always be there. I do this because this way it automatically eliminates your random. You always have these kind of weird random stocks that trade, 3,000 shares a day that they jump up and down, and there's a lot of them. So let's just get rid of those with these. So these criteria, get rid of that. Now we can go to a very simple function, which is go to price, and then we go to percentage of 52-week high low, and this will and then we'll say greater than 80. So it's going to do is it's going to take your full price range, and then it's going to say, are you, and it's going to basically go from 0 to 100%, and it's going to say, where are you in that range? So now I'm going to hit, now I added that. And one more thing, just to keep it straight, I'm going to go for indicator, and because a lot of these are going to be companies we've never heard of. Let's know what they are before we even see. I'm going to go to industry. There's a little hack I love that I always show you guys how to do. I'm going to set to does not equal quote, quote, meaning it does not equal nothing, which means that it will simply populate a value data. So I'm going to go ahead and hit run. Now while it's running, I notice something over here. I have my MT main set up. You'll notice I have my cyan symbol linking. So I'm going to go back over to this scanner, and I'm going to change it to cyan symbol linking global. So then when I check on some of these names, this is what I got here. And we can see that we have Apple on our list and stuff like that. But that's because of alphabetical order. So now we can just look right off the bat at these names. And if I click on any of them, you can see that they'll actually come up on the other. So I just click on Autodesk, and it popped up. You can see it's coming up over here. So it's very interesting to see. I look at that chart. It doesn't look that different from GoDaddy, does it? That's interesting. I have no idea what's happening with this one. But again, these are the sort of names that people just forget about, and then and they come screaming back. So I think it's interesting to kind of notice that. Look at this chart pattern. I'm seeing this pattern a lot of stuff rallying back to the 52-week high resistance, a tight consolidation and continuation. Look at the XLF. Look how it just rallied back. It's not even the 52-week high. It just rallied back, sat there, held, and then just took off. So this pattern is popping up a lot in the market, and I would suggest that it's indicative of names that are under new accumulation and getting noticed. So with this scanner, another thing we can now add to it is we can then add another line. We can add price, and then we can say net change percent 5-day, and then let's just set it to, I just set it to greater than minus 99. Again, some of these values are actually throwaway values, but the reason we do them is because it allows us to see more data in Scanner, which we can then sort on. So if I look on this list, I can kind of say, oh, VERX, that's interesting. I can go over and look at this on the other chart. This is like a small, high multiple data, like cloud data stock. But it's interesting to see some of these because, not now, but, will it come down to this low from mid-November? It is probably an earnings report here, some kind of breakout. The Keltner channel is catching up. So a name like this, over the course of next week, will it base and follow through? Those are the kind of questions that I'm going to be asking when I'm looking for different ideas and things. And I think these are some of the opportunities we might start to see by running this scan. So anyway, these are just some of, I think, the key things I wanted to show you guys in Scanner. These tools that I have here, distance from 52-week high is pretty much the same thing as that percentage of 52-week range high and low. You can also do days since 52-week high low as an indicator and bring it into Scanner. Let me just show you how to do that. I'm going to click on this again, and I'm going to go now to, in this case, it's an indicator. So I'm going to go to indicator. I'm going to go to days since. This is another one that's included in your, this is a custom one that is included in the zip file that I share with you guys. And we go to days since 52-week high low. Add that, and then make sure it's set to high because it can also show lows. High, and then we're gonna, now this one we're gonna less than, let's say less than 20. Okay, make up a number. 21. That's a month. 21 candles is a month. You know that you like trading when you refer to days of your life as a candle. Anyway, that's running now. All right, so also very quickly, as that's running in the background, I'll take you to the MA Tools workspace. Now, there's another one to kind of look at here because this is going to show us things that are pulling back to test things like the 21-day exponential moving average. Let's see. A lot of these things are not even going to be very useful at this moment. The kind of move we have in the market now is not going to kind of tell us anything very useful in my view. But there's other times when it can work very nicely, when things pull back and sit at moving averages. In my view right now, if anything, if you're pulling back to something like the 21-day or the 50-day, there's a good chance that you're actually getting sold to make space for new names. Like I said, these big names like Google, people are selling that to buy Blackstone, for example. So it's not necessarily a sign of strength. And, if it is the case that we see more of this sort of rotation over the course of the new year, then a lot of these names and these signals will not necessarily work. But here's an idea, and I don't have time to do this now. What if a stock made a 52-week high in the last 2 weeks, the last 10 candles, and it's touching the 21-day exponential moving average? That could actually be a sign of a sort of breakout. I think we had something like that. We did this, for example, Cadence. Wasn't quite like this. So it had a new 52-week high here. It pulled back toward here, hit the 50-day, went a little bit lower, but then it continued higher. So this was an example of how to, this thing sort of could be used. It would have been flagged here. We did a trading view ID on it somewhere here. It went a little bit lower and then it exploded higher. So the thing is this is the kind of the approach that you could potentially be looking for. The fact that it makes that high puts it on the list. And let's take a look over here at what we got. And now we can look at these names. We can see I'm looking at stocks that made highs in the last 20 days or something. Here's one, CDW. I've watched this one a lot. See, that one made a 52-week high there. And this, just so you know, the indicator days and 52-week high goes from yesterday, not today. So it's making a new high today when it had not previously. All right. Those are the main things I want to show you. And the main other thing I want to mention is that this environment is no longer consistent with negativity toward energy and crude oil. We had talked a lot about the downside risk in energy, but the thing is that this environment is a value environment. People are looking for cyclical growth, things like that, and it's not probably a bull market for energy, but the idea of just continuing to club energy lower is no longer the trend. I would also say most of these are going to be value stocks, or you're going to be cyclicals. They are the same kind of stocks in many ways as industrials, financials, retailers, those names that have been outperforming home builders. They're more, not quite home builders, but they're more like a financial, thematically and categorically. So now you're kind of in a spot where the energy names, could have some bouncing. It's also interesting that this is an important breakout level right here on crude oil. We had talked about this at the time. If you go back and you look on market trends, we had talked about how it was breaking this falling wedge and it had that decent rally. And this level right around here is important as the breakout line. And now we're bouncing at it. So I think at this point in time, there will be an opportunity to hit energy again, probably on the downside but at this point in time, it seems to have run its course. All right. Those are the main things I want to talk about. Last thing here, actually, this sentiment number on the AAII, 19.3 is the lowest reading of bearish since January 4th of 2018. So we've swung pretty hard here from 50% bearish, which was the highest reading in a while, to 19% bearish. So this has been a revolution in sentiment. All right, so it's great to talk to you guys as always. Remember, this is our last market trends of the year. We will be back on the 11th of January. And we just also mentioned down at the bottom here, I didn't even have time to talk about it. Samsara IoT. This is an interesting breakout as well. You guys might want to check this out in our blog post. And then also upcoming events. Next week, we have this housing data, which is going to be interesting. Especially when you look at the move we've seen in the home builders since then. And Nike reports earnings next week. But this was the last big stuff of the year. Just a little bit more housing data next week. Tomorrow is quadruple witching, but again, when you have the kind of volume and activity we've seen recently, I'm not sure what any of that means. So hope everyone has a great day. Wish everyone a Merry Christmas, Happy New Year, Happy Holidays, and I will see you on the 11th, the second Thursday of next year. Take care, everyone. Thank you much.